Novartis just beat consensus on the top line for Q2 2026, pulling in $14.4 billion in net sales, but they missed the mark on the bottom line.
Right. Actual net income dropped 19% to $3.25 billion. And core EPS hit $2.41, which is basically flat year over year.
Yeah, and management reaffirmed their full-year guidance. So low single-digit sales growth, but a low single-digit decline in core operating income.
Exactly. And you can see the market digesting that mixed bag today. The stock is trading slightly down after the report, mainly because of those underlying margin pressures.
Right. The top line looks okay at a glance, but underneath those headline figures, there is a massive structural shift happening.
Oh, absolutely. We're looking at a rapidly changing product mix, intense generic competition, and some, frankly, very aggressive capital allocation playing out on the balance sheet.
Okay, let's unpack this. Because if you're a retail investor tracking the healthcare sector or just trying to understand modern pharma strategy, this deep dive is for you. We're pulling directly from Novartis's official Q2 2026 earnings presentation, their press release, and the condensed interim financial report from July 21st.
And the mission here is really to decode this intense balancing act. Novartis is, they're executing a massive corporate pivot right now.
They really are. They're trying to fight off a brutal wave of generic competition by leaning heavily on new blockbuster drugs, complex gene therapies, and a huge shareholder payout strategy.
It's essentially a textbook case of how the pharmaceutical life cycle works in real time. You're watching the legacy cash cows dry up, while a handful of new growth drivers carry the entire enterprise.
Right. And to understand why they're doing all this, we really need to start with those top-line numbers and the incredible gravity of generics.
Yeah, the generic drag is real.
It's huge. When you look at that $14.4 billion in sales, there's this fascinating tug-of-war happening. Volume growth was actually massive this quarter.
Right. Pushing more product out the door contributed 18 percentage points to the top line.
Which is wild. Like in almost any other sector, an 18% volume bump means you're having an absolute blowout quarter.
Oh, yeah. You'd be popping champagne.
Exactly. But then generic competition eroded that progress by a staggering 14 percentage points. And pricing impacts took away another 3 points.
Yeah, so they're basically running up a down escalator.
Right. They put in 18 steps of forward effort through sheer commercial execution, but the generic market escalator just instantly pulls them backward by 14 steps.
What's fascinating here is the sheer velocity of that downward pull. In pharma, volume growth can easily mask a massive leak in the bucket. And the prime example of this in the Q2 report is their cardiovascular drug, Entresto. I mean, this was a foundational mega blockbuster for them.
Yeah, let's look at those numbers. In Q2 of 2025, Entresto brought in $2.35 billion this quarter. It plummeted to $1.18 billion.
That is a 50% drop in a single year.
Over $1 billion in quarterly revenue just vaporized.
Poof. Gone. And just as a quick refresher, for those tracking the generic models, when a drug like Entresto falls off a cliff like that, it's because it's a small molecule drug.
Right.
It's essentially traditional chemistry. You spend billions on R&D, you get a temporary patent monopoly, but the second that patent expires...
Your recipe becomes public.
Exactly. And third-party generic manufacturers can easily reverse engineer it. They flood the market, insurers force patients onto the cheaper pills, and your $2.3 billion run rate gets cut in half almost overnight.
You essentially have to recreate your entire revenue base every few years just to stand still.
Yeah, treadmill.
Which naturally brings up the immediate question. If the escalator of generics is pulling them down that fast, how is Novartis managing to stay in positive growth territory at all?
Well, they still posted that 3% overall growth.
Right, and that brings us to their growth engines, moving from the legacy drag of Entresto to their new priority brands. According to the presentation, these priority brands surged by 36% in constant currency.
And that 36% surge is the life raft right now.
Yeah.
It's a highly concentrated portfolio doing the heavy lifting for the whole company. Let's look at the standouts.
Okay, so Kisqali, their breast cancer therapy, grew an incredible 43% to $651 million.
Outpacing the broader CDK4/6 market, by the way.
Right, explicitly noted in the report. Then you have Leqvio, a cholesterol med, which surged 59% to $480 million. Cosentyx grew 10% to over $1.8 billion, mainly driven by the U.S. And a leukemia drug, Scemblix, rocketed up 89% to $225 million.
Those are phenomenal growth rates for commercial stage assets. And, it's worth pausing on Kisqali because it perfectly illustrates how pharma companies actually drive growth post-launch.
Well, let me push back on that a bit. If a targeted cancer drug like Kisqali is growing at 43%, are they just squeezing every last drop out of a very specific finite TAM? Or is this genuine market expansion?
That's a great question, and it gets to the heart of lifecycle management. Growth isn't just about deploying more sales reps to find the exact same patients.
Right, you'd run out eventually.
Exactly. It's about fundamentally expanding the addressable market by proving the drug works in new, broader indications.
So changing the parameters of who is actually eligible for the prescription?
Yes. The earnings presentation points out two critical factors for Kisqali. First, they secured FDA pediatric exclusivity,
Okay.
which is a massive regulatory mechanism. By running trials in a pediatric population, the FDA rewards the company with an extra 6 months of market protection across all existing patents.
Wow. So by proving it works for a tiny fraction of pediatric patients, they get an extra 6 months of monopoly pricing for the massive adult market.
Yeah, and for a drug doing billions a year, an extra 6 months before the generic escalator kicks in is worth its weight in gold.
Unbelievable.
But the second factor is even more important for immediate volume. They presented updated overall survival data, or OS data, in early breast cancer.
Let's break that down for the listeners. What does overall survival data in early breast cancer actually change in the real world for a doctor writing a script?
It changes the entire treatment timeline. Initially, these powerful targeted therapies are approved for late-stage metastatic cancer, patients who have run out of options.
Right.
But pharma companies keep running trials. They start testing the drug on patients in earlier and earlier stages of the disease.
Ah, okay.
By proving Kisqali helps patients survive longer in early-stage breast cancer, they convince oncologists to use the drug much earlier in the paradigm.
So they aren't just squeezing a finite market of late-stage patients. They're moving upstream.
Exactly. They capture patients earlier, which vastly increases the total eligible prescriptions, and patients stay on the drug longer.
That continuous investment in phase 3 and 4 trials is how a brand offsets massive losses from a patent cliff like Entresto.
Yep, it's all about label expansion.
Here's where it gets really interesting, though. Kisqali and Lephio are the life rafts today. They're fighting the generic drag right now. But what happens in, 2032 when they hit their own patent cliffs?
Right, they can't just play chemical whack-a-mole forever.
Exactly. And looking through this earnings report, there's a distinct thematic shift in what they're developing to replace these current drugs.
It's a fundamental pivot in their scientific approach.
Yeah.
And honestly, it's crucial for understanding the long-term valuation of the stock.
Let's look at the pipeline advancements. Rapsido gained approval in Europe and Japan for chronic spontaneous urticaria. Then there's Visma, which just gained European Commission approval as the only gene replacement therapy for a broad SMA spinal muscular atrophy population.
Yeah, it's a big one.
They also submitted a biologics license application for Delzota in Duchenne muscular dystrophy and reported positive biomarker data for Delbrax in FSHD, another type of muscular dystrophy.
If we connect this to the bigger picture, you'll notice a massive shift in those last three.
Yeah.
SMA, Duchenne, FSHD.
Right.
These are rare, genetically driven, devastating diseases. And the treatments aren't traditional pills, they are advanced biologic and gene replacement therapies.
Right. They aren't synthesizing a simple chemical recipe in a vat anymore. They're literally trying to replace or alter missing genes.
Yes.
But why the heavy strategic shift toward ultra-rare diseases and complex genetic tools? Is the science just getting better, or is there a financial imperative?
Oh, it is deeply strategic from a financial perspective. Think back to Entresto. Small molecule chemicals are relatively easy to reverse engineer.
Right, the barrier to entry is low once the patent drops.
But gene therapies aren't chemical recipes. They are incredibly complex living systems. Manufacturing a biologic like Visma involves cultivating living cells and using viral vectors.
And maintaining those crazy, precise, clean room environments.
Exactly. The complexity of the manufacturing process itself becomes a physical barrier to entry.
So even if the patent on a gene therapy expires, a generic manufacturer can't just set up a factory and start churning out copies for pennies.
No, they'd have to create a biosimilar, which requires specialized facilities, massive capital investment, and totally different regulatory hurdles. It's so expensive that many generic manufacturers won't even attempt it.
Which means this pipeline isn't just about curing rare diseases. From an analyst's perspective, this is Novartis building a massive strategic moat.
Yes, they are transitioning their entire revenue base to highly complex, high-margin, sticky therapies that are naturally resistant to the very generic competition they're suffering from today.
You're replacing an easily copied product with one that's fundamentally difficult to replicate. But, and this is the crucial transition for our analysis building, that moat is breathtakingly expensive.
Oh yeah, you can't just pivot into gene therapy for free.
No, you can't. So what does this all mean for the balance sheet? Let's look at the financial toll of this strategy and how they're balancing the checkbook.
This is where the income statement and the cash flow statement tell a slightly more strained story than that 3% sales growth.
You can see the strain clearly. Core operating income was completely flat at $5.9 billion. Actual net income dropped 19% to $3.25 billion.
Yeah, higher taxes and higher interest expenses were the primary culprits there.
Right. And free cash flow dropped 12% to $5.56 billion. But if you're a retail investor, there's one number that really jumps off the page and kind of hits the panic button.
The debt.
The debt. Net debt increased massively by $17.5 billion.
Yeah, adding $17.5 billion in debt in a single 6-month period is a significant leveraging of the balance sheet.
And the report breaks down exactly where that borrowed money went. $15.3 billion was spent on M&A and intangible assets, basically buying other companies and their pipelines. And alongside that, they paid out a $9.1 billion annual dividend. On top of that, they're continuing a share buyback program of up to $10 billion with about $5.6 billion left to go.
They're aggressively utilizing their balance sheet right now, borrowing heavily to fund future innovation while simultaneously keeping immediate returns flowing to shareholders.
Okay, let me ask the pointed question on behalf of the listener here.
Go for it.
They are making less net income, free cash flow is shrinking, and they just added $17.5 billion to their net debt. Yet, they're handing out a $9 billion dividend and buying back billions in stock.
Yeah.
Taking on debt to pay dividends usually raises massive red flags. Is this just financial engineering to prop up the stock while the core business gets squeezed?
It's a fair question, and it really highlights how capital allocation works at maturity in the pharma sector. From the outside, leveraging debt to buy back stock looks super dangerous.
Right, like if my personal free cash flow was down, I wouldn't take out a bank loan to pay my friends a dividend.
Exactly.
Yeah.
But for a company of this scale navigating a transition, it's actually standard practice. You have to look at the underlying cash generation.
Okay.
Even with free cash flow dropping 12%, Novartis still generated $5.56 billion in pure cash in 1 quarter.
That's true.
In the pharma life cycle, you inevitably hit periods where your internal R&D just hasn't invented enough to offset a patent cliff. When that happens, you have to use your balance sheet to acquire future innovations.
Right, that's the $15.3 billion in M&A. They're explicitly buying those complex gene therapies we just talked about.
They realize their escalator's going down, so they're buying a new one that goes up.
That makes sense.
But here's the catch. When you buy an early-stage gene therapy company, it takes years to get those drugs through FDA approval.
Right, you're waiting on the pipeline.
Exactly. And while you wait, you have to keep your current investor base patient. Pharma stocks are heavily owned by pension funds and institutions who expect a reliable dividend yield.
So if Novartis suddenly cuts its $9 billion dividend to fund a gene therapy acquisition, those income investors dump the stock.
And the stock plummets, which limits their ability to raise capital later.
Yeah.
So as long as the core business continues its substantial cash generation, leveraging debt to maintain payouts while buying the future is a calculated risk.
They're essentially bridging the gap, paying for the patience of their investors with dividends and buybacks while they build that complex gene therapy moat.
It's a delicate balancing act, and it does leave them with less margin for error. If those newly acquired assets fail in trials, that $17.5 billion in new debt becomes very heavy.
That is exactly why the 2026 guidance is so critical. By reaffirming low single-digit sales growth, management is signaling that the core cash engine is stable enough to support this tightrope walk.
Absolutely.
So to recap this deep dive, if you look at Novartis right now, you are seeing a perfect case study of the modern pharmaceutical life cycle. They're battling a brutal 13% generic drag that literally wiped out half the value of legacy drugs like Entresto in a single year.
Yeah, that 50% drop is wild.
They're countering that with incredible 36% surges in priority drugs like Kisqali, mainly by proving those drugs work in earlier stages of disease.
Right, expanding the label.
At the same time, they're pouring billions into acquiring complex gene therapies for rare diseases to build physical moats against future generics, and leveraging their balance sheet to keep shareholders happy during the renovation.
That's a high-stakes transition. They're trying to cross the bridge from easily copied chemical pills to highly defensible biologic treatments.
Which leaves you with a final thought to mull over as you watch the healthcare sector. If traditional chemical drugs inevitably face a patent cliff that wipes out half their value overnight,
Yeah.
and the entire industry's response is to pivot into ultra-complex, multi-million-dollar gene therapies that generics fundamentally cannot copy, are we approaching an era where the concept of the cheap generic drug starts to vanish entirely?
Man, if the future of mass medicine transitions to bespoke genetic modification, the economics of healthcare are going to change at a very fundamental level.
Something to keep in mind next time you're at the pharmacy counter or, looking at a pharma balance sheet. Keep questioning the numbers behind the news. And make sure you follow the show for daily earnings coverage as we continue to break down the quarter's biggest financial reports.